Hello everyone and welcome to our video on business entity types. Today we'll discuss the general differences between sole proprietorships, partnerships, corporations, and LLCs. Like and subscribe for more informative videos and let us know in the comments what you'd like to see next. The first type of entity that we'll look at is the sole proprietor. This is the default type for the single owner. If you don't do anything else and just start selling your product or service, you'll be considered a sole proprietor. This type of entity consists of one owner, unless you're a married couple who is qualified for and elected to have the business treated as a qualified joint venture. Sole proprietorship is the least complex of the entities because there's no paperwork to start, no partners, just you and your dream. On the other hand, it also saddles you with unlimited liability. There's no barrier separating you from your business liabilities and debts. A successful lawsuit against your company could also affect your personal assets. It's also harder to build your business credit. Since you are personally responsible for your business debt, your credit is based on your personal credit worthiness. Your income and expenses are generally reported on a Schedule C with your personal tax return. A sole proprietorship usually has the least amount of administrative expenses when compared with other business entity types. Now let's say it isn't just you and your dream. It's you, a partner in a dream. Your entity would be considered a partnership. Like sole proprietorships, partnerships are pass-through entities. This means that they don't file a separate tax return and pay income tax at the company level. The company files a Form 1065, which is an informational return with the IRS. It also gives each partner a Schedule K-1 listing the individual partner's share of income, deductions, etc. You use this schedule to complete your personal tax return if you were a partner. This is true for each of the types of partnerships that we'll discuss. The first we'll look at is the general partnership. This is equivalent of a sole proprietorship with two or more people. There are no formalities. You don't even have to have a written agreement. I strongly advise against this. There's more capital available because there are more owners to contribute. On the downside, there's unlimited liability for all partners. While you can't purposefully make a bad deal to enrich yourself, if you do happen to make a bad deal due to poor decision making, your partners are going to be bound to the debt too. Partnerships are like marriage. There will inevitably be squabbles and disagreement. It can be just as painful and expensive to divorce your business partner as it would be to divorce your spouse. Choose wisely. The same pitfalls you find in building business credit for sole proprietorships also affect the general partnership since it's based on personal responsibility. Maybe you've decided that a general partnership isn't right for you. Let's look at limited partnerships. In this type of partnership, there are two kinds of partners: the general partner, which we just discussed, and the limited partner. Limited partners get more protection than general partners. For this reason, limited partnerships are required to have an agreement in writing, and the agreement must be filed with the state. This type of agreement allows investors to serve as limited partners without assuming responsibility for the company's debts and liabilities. The most that a limited partner can lose is the amount of the investment in the business. In exchange for release from the debt obligations, the limited partner has no control over the day-to-day operations of the business and is not involved in the management. Because limited partners do not participate in management, the partnership does not have to be dissolved upon their death or withdrawal. General partners are treated the same in a limited partnership as they are in a general partnership. Limited partnerships are different than limited liability partnerships. Limited liability partnerships can only be created by professional services firms, accountants, doctors, lawyers, architects, etc. Requirements may vary by state. In a limited liability partnership, there is no general partner. None of the parties are responsible for the business debts and losses. Partners have protection against malpractice lawsuits against other partners, although they can still be sued for their own malpractice. Next, we'll look at corporations. The first type we'll discuss is Subchapter C Corporation, or C Corp. This is what most people consider the standard corporation. Owners and entities are taxed separately, which means that the company is taxed first on the income that it earns, and the shareholders are taxed on that same income when it is distributed to them as dividends. This is what is commonly referred to as double taxation. Paperwork and organizational requirements are the most onerous for C corporations. Articles of incorporation must be filed, a board of directors must be appointed, and they must have at least one meeting each year for shareholders and directors. That's the minimum. Regular meetings are often held monthly or quarterly, and special meetings are called when important business needs to be addressed. The minutes of each of these meetings, voting records, and a list of owners' names and ownership percentages must be maintained. Unlike other entity forms we've already discussed, corporations must create a set of company bylaws and keep them on the premises of the primary location. Annual reports, financial disclosure reports, and financial statements must be filed. The trade-off for this administrative work is the advantage of limited personal liability. The corporation is considered an entirely separate person. With C corporations, there are no restrictions on the type of individual or entity that can purchase stock. Foreign citizens or other corporations can purchase stock in C corps. That isn't allowed in S corporations. C corps can have an unlimited number of shareholders. However, once it reaches $10 million in assets and 500 shareholders, it will be required to register with the SEC. Unrestricted and unlimited shareholders means that C corporations can often raise larger amounts of capital than other types of entities. Maybe you don't want to be a C Corp. You want something smaller. Let's look at the C Corp's little brother, the subchapter S Corporation, or S Corp. It offers the limited liability of the corporation, but is a pass-through taxation like partnership or sole proprietorship. Unlike those, the S Corp files an 1120-S to report its income and issues a K-1 to the shareholders, even if it's only a single shareholder. The shareholder then pays the income tax on a personal tax return. Where the C Corp allows unlimited shareholders with multiple classes of stock, the S Corp has a limit of 100 shareholders and one class of stock. Shareholders are more restricted in S Corps as well. They must be individuals, specific trusts or estates, or certain tax-exempt organizations. Partnerships, corporations, or non-resident aliens do not qualify. So if you want your already established corporation or partnership or foreign citizen to be a shareholder in your new corporation, you'll have to go with a C Corp. It's not allowed in an S Corp. Now the next part is pretty important, so I highlighted it. It's the part that trips up a lot of taxpayers. S corporations must pay reasonable salaries to shareholder employees for services rendered before distributions are made. You can avoid self-employment tax by simply taking distributions. You need to consider the cost of payroll administration on top of your salary when choosing an entity form like an S Corp. Filing requirements are similar to C corporations. Articles of incorporation must be filed with the Secretary of State. File Form 2553 with the IRS to elect to be taxed as an S Corp. File Informational Tax Form 1120-S annually to report pass-through income or loss. Structure is like C Corp in that shareholders are the owner of the company and elect board of directors who appoint officers to manage daily affairs. Both S Corps and C Corps are required to adopt bylaws, issue stock, hold shareholder and directors meetings, file annual reports, and pay annual fees. It's a little more difficult to raise capital as an S corporation because the number and type of shareholders are more restricted than C Corps. We're to our final entity form, the LLC, or Limited Liability Company. It has become popular in recent years because it offers the limited liability seen in corporations with the pass-through taxation found in sole proprietorships and partnerships. An LLC can be taxed as a sole proprietorship on a Schedule C, as a partnership on a Form 1065, or it can elect to be taxed as an S Corp, Form 1120-S. LLCs require filing with the Secretary of State. Unlike corporations, they may not survive the death or bankruptcy of a member. They are not considered a separate person like corporations and are more closely interwoven with the member. There are generally few restrictions regarding ownership in an LLC. LLCs can have any number of owners, and they can be individuals, corporations, other LLCs, or foreign entities. A few types of businesses generally cannot be LLCs, such as banks and insurance companies. LLCs aren't required to maintain as much member paperwork or meet annual meeting requirements like S or C corporations. LLCs can be perceived by vendors and customers as more legitimate than sole proprietorships or general partnerships. Professional limited liability companies, or PLLCs, are also available to state licensed professionals in much the same manner as limited liability partnerships. That concludes our general overview of the types of business entities. I hope you've been able to learn something new today. If you'd like to schedule a free 30-minute consultation, you can choose an appointment on our booking page. Otherwise, check us out on the web and Facebook. Let us know what you'd like to see next.